Good day, everyone. Today I'd like to give you guys an introduction to harmonic trading. Now, the first harmonic pattern was discovered all the way in 1935 by H.M. Gartley. As the name says it all, you can see here this harmonic pattern is labeled Gartley. This was the first harmonic pattern to be discovered. And as I said, it was discovered by H.M. Gartley in 1935. 1935 is a very long time ago. It's actually 84 years ago. So imagine that a pattern that was discovered 84 years ago still works in the market today. As you can see here, this is an actual Gartley pattern, and you can see that you did get a price reversal. Okay, and this is actually on the 4-hour time frame, so this is actually a very big price reversal. Let's see if we can measure this reversal here. We have 100 and approximately 150 pips. That is a very big move, and you could have gotten at least part of that, at least half of that, from trading the Gartley pattern. Okay, so how do we come up with these measurements that we use to construct the Gartley pattern and other harmonic patterns? Well, we do have other harmonic patterns, as I just mentioned, and they come from the works of Bryce Gilmore and Scott Carney. Now, those are just the publicly known harmonic pattern. I have over 58 harmonic patterns. Okay, so I hold 58 harmonic patterns of my own, and so I hardly use these other harmonic patterns that were discovered by other brilliant traders and analysts. So how do we come up with these measurements? Bryce Gilmore and Scott Carney ascribed specific Fibonacci measurements to harmonic patterns, and they allow us to be able to now know exactly where the price should be reversing. Okay, so how do we apply these measurements to create a harmonic pattern? Let's bring on an illustration of the Gartley pattern, and basically what you do is from your X, which based on if the pattern is a bullish pattern or if it's a bearish pattern. This example I have up here is actually a bearish pattern, right? So, and it's unfortunate, I should say, that the example that I'm using and the illustration that I found online is actually the same formation. It's both bearish, and you can see they look almost identical to each other. Okay, so basically what you're looking at is the highest point that the price came when moving up. It pulls back. When it pulls back and goes up, retraces, creates another swing by coming down again, and then creates another swing by going up again, breaking this swing's high. Okay, the last one that goes up should not break the area where you started to plot this pattern. Okay, so we look at this as our X, and our D should not surpass our X. Okay, so in applying Fibonacci, let me just take this off. In applying Fibonacci, let's just pull up the Fibonacci retracement tool. We start from the X. But before I even do that, remember, I won't advise anyone to start looking to plot a harmonic pattern just because the price, came down. No. I would say you need to see at least the first move down, the second move up, and then one more move down before you start even trying to forecast this pattern or any other harmonic pattern. Okay? You're just going to give yourself too much work.